Facebook's first quarter results are out, and we have updated our earnings model. There are a couple of things that we want to go through. So the earnings call is still going on right now. They're at the question and answer point of the call, but they finished going through the guidance for 2016. So we've updated our model to include that. So just going through the top level items, they talked a little bit about revenue for the rest of the year, and there's really no change there. So revenue growth is expected to continue, but the company will face tough comps as the growth rates for last year were so strong. And then for payments and fees, they expect the trend to continue of declining revenue in that space. I don't think they actually mentioned anything about currency fluctuations in the guidance section, but they did mention it earlier in the call, so that would continue as well. And then from the expense standpoint, the GAAP expenses, they left those unchanged, which was actually a little bit surprising since they had such a strong quarter. So they're still expecting 30 to 40% total GAAP expense growth year over year. And they left the non-GAAP expense unchanged as well at 45 to 55%. And we'll go through that in the model. For the CapEx, they now expect to come in at the high end of their previous range of $4 to $4.5 billion. Stock-based comp is expected to still be within the $3.1 to $3.3 billion range, and amortization expense is still expected to be between $700 and $800 million. So the one bright point on the new guidance is that the tax rates are were expected to be in the low 30s previously, and now they're guiding to a similar rate to what we've seen in the March quarter, and that rate was about 27% effective tax rate. So that actually had a pretty good impact on overall earnings for the rest of the year. They also mentioned that they have the new class of shares that are starting. So they're going to have a Class C, and the impact will be basically a 3-for-1 stock split. So this is kind of similar to what we just saw with Under Armour, where there's a new class of shares, and that's dividend out to the existing shareholders. So all the Class A and Class B shares will get one additional share of Class C. So we're not actually making any adjustments in our earnings model at this point because that still needs to be approved, and we'll have to get a little bit more details in how the structure will work before we can input that into our results. But, for the time being, at least they announced it here so we can start prepping for it. Okay, so let's take a look at our model here. So on the right-hand side of the screen, we have the model with this quarter updated and the updated guidance for the full fiscal 2016 year. And before we compare that to the old model, if you want to download this model, it's available on our website. We've now included the results from tonight. So if you go to our models page, scroll down to Facebook, and click the icon, you can see here that we've shown that it is including the 1Q16 results. So click the icon and it will download. And what we're going to do is we're going to compare the March results, the actual results, and our 2016 estimates to what we had in the model previously. So first, let's just go through the income statement really quick. So you can see that the consensus revenue estimate was $5.3 billion. And 5.259, and they came in at 5.382. So they beat on the top line. If you take a look at the gross profit, which also beat, and operating income on a GAAP basis came in strong. So the street was expecting about $1.9 billion, and it came in just over $2 billion. And you can scroll all the way down to the diluted EPS, and you can see that the street was expecting about 63 cents per share, and it came in at 77 cents. So overall, very good, strong results. If we get down to the segment details, we're going to show you, we actually had to make some adjustments to our June and September results just because things came in much better than expected. So if we look at the total monthly active users, there wasn't really a huge change. So overall, we were expecting 1.652 billion. It came in at 1.654. So we didn't actually change our growth rates for the June or September quarter. You can see that these are the same as here. And if you look at US and Canada as the most important region, that we had expected 1.5% growth, and it came in at 1.4. So not a big difference there. So we're not changing those growth rates. But if we look at our average revenue per user, so we were expecting $11.66 per user for the quarter in US and Canada, and they actually earned $12.43. So that was way ahead of our expectations. And then Europe also came in way ahead of our expectations. So you can see we expected $3.75 per user on average, and it actually came in closer to $4. So for those two regions, we decided that we'd have to increase our ARPU, our average revenue per user, in the next couple of quarters. So let's take a look at what we had. So previously, we had about $12.50 in June. We increased that to $13. So that's about 50 cents more than what we had per user. And basically, we used this to inform our decision to do that. So we had expected $11.66, and it was almost a full dollar above what our expectation was at $12.43. So we decided to go a little bit more conservative. Rather than increasing this by $1, which would have been $13.47, we just increased it about 50 cents to $13 even. And then we increased the September quarter also by 50 cents, so that got us to 13 even there as well. And then for the December quarter, we increased that by a little bit less, by $15.50 per user. And then for Europe, we increased that. Let's see here. We increased that by about 25 cents. So if you look at the actual was close to $4, which was about 25 cents more than what we had anticipated. So we took this $4 and we added 25 cents. So that's how we get to $4.25. And then we increased the September quarter slightly to $4.50, and then the December quarter to $4.75. So we usually like to keep those future growth rates stable, but just because the average revenue per user was so strong this quarter, we thought that it didn't really make sense to do that. Then scrolling down our model a little bit further, you can see if you watched our preview video, we talked about this virtual reality business, which we incorporated into our model here. So far, they haven't mentioned any details about that on the call, so we're not actually going to change this. In this latest question and answer section, they might actually talk about it a little bit, and if they do, we'll incorporate some of those comments in here. For the time being, though, this is just really not a huge contributor to earnings. You can see we set our gross margin on Oculus Rift to 0%. Yeah, that's not how you spell gross. So this isn't actually impacting our net EPS estimate. It is impacting our revenue slightly because we're expecting some shipments next quarter, and at about $600 per unit, and 200,000 shipments would be $120 million in overall revenue. So a drop in the bucket for Facebook's overall revenue, but still a good placeholder here. So when this business ramps, we'll be able to update our model pretty quickly. Then you can see all these light blue cells are just indicating that we actually made an adjustment to the future periods. So if we look at the core gross margin for Facebook, we had expected just below 84%, and it came in about 50 basis points above our expectations. So we really just wanted to bring that June quarter up slightly to reflect that. So we brought that up to 84.4%. We didn't touch September or December, but I think this is just a more reasonable basis given the fact that they had such a strong showing on the gross margin front this quarter. Then if we take a look at R&D, so this is now where the guidance that management gave us comes into play. So you're understanding our revenue estimates going forward based on our changes to ARPU. You can download this model if you'd like and put in your own estimates in the blue cells if you disagree with our ARPU assumptions. But that gets you down to revenue. And for expenses, management gave us guidance. So first of all, we were a little disappointed that they didn't actually bring their expense guidance down because they did have a strong quarter. But even still, that's fine. So we basically needed to get back to this midpoint of the GAAP guidance that they gave. So they reiterated the 30 to 40% range. And then what we did to get back to it is we changed this R&D expense as a percentage of total revenue. So we had to bring that down now because the revenue base was a little bit higher based on our changes to the ARPU. So we changed the R&D percentage for June, September, and December, and you can see now we are getting back to the midpoint of that 30 to 40% range. And then in regards to the non-GAAP expenses, so they also reiterated their guidance there between 45 to 55%, and we didn't actually make any adjustments for that except to bring our stock-based comp and our amortization of intangibles back in line with management's updated guidance. So they reiterated the guidance on the stock-based comp at between 3.1 and 3.3 billion. And also they kept the amortization of intangibles the same at between 700 and 800 million. So if you look at amortization, it was 180 before, and so this would imply that it's going to be 190 for the next 3 quarters, which is probably unlikely because it usually stays pretty stable. So you can see it's on average been 183, and it was 180 last quarter, so it's probably going to be closer to 180, but either way that won't have a big impact on overall non-GAAP earnings. So we just, for the time being, said it's probably safer to just be at that midpoint of management's guidance, so that's what we did here. So now, after incorporating all of those assumptions into our model, you can see that our total estimated EPS for 2016 has moved to $3.55. And let's put the other model side by side again. So prior to this release, we were at 303. So earnings have actually come up quite a bit just based on those assumptions. And if we look at our share valuation, so you can see our price earnings multiple based valuation moved from $108 per share to $124. And our DCF actually stayed constant. So the reason the DCF stayed constant is 2 parts to that. One, the majority of the valuation from a DCF standpoint is actually coming from the terminal value. And since we didn't change our long-term growth rates, that terminal value didn't change much. And then the other side of it is there was a CapEx impact. So management reiterated the guidance for CapEx, or the range for CapEx, but they now expect to be at the high end of their range. So we actually had to increase our CapEx expectation this quarter, which had a negative impact on our DCF valuation. So overall, the price move based on our model is 115 using that 50-50 basis, 50-50 weighting of the 2 approaches. So move from 107 to 115, which is a little bit lower than what we're seeing in the after hours move right now. But that's probably just reflecting the fact that our ARPU assumptions are probably on the conservative side. So I think the market is probably anticipating analysts to actually increase their revenue and EPS estimates quite a bit. And they might actually find themselves at that low end of management's guidance on the GAAP expense range just because the results were so strong this quarter. So that is the review, and as I said, the model has been updated on our website, gutenbergresearch.com. So definitely go and download the model and check it out for yourself, plug in your own assumptions, and see what the earnings results are with your new updates. And thanks for watching, and good luck with the rest of earnings season.